you've probably heard the rule 100 times. When crisis hits, move to safe assets. Gold, government bonds, reserve currencies. The financial equivalent of a bunker, and on paper it makes perfect sense. When the world becomes unstable, capital should logically flow toward stability, toward things that governments can't easily destroy, toward assets with centuries of credibility. But financial history contains a strange and uncomfortable pattern. The moments when investors most desperately run towards safe assets are often the exact moments those assets begin behaving in ways no one expected. Sometimes they surge, sometimes they freeze, sometimes they quietly fail to do the one job they were trusted to do: protect wealth. And if you trace the pattern far enough back, you start noticing something unsettling. Many of the most famous financial crises in modern history weren't just about markets collapsing. They were moments when the very definition of safety turned out to be an illusion. Human beings hate uncertainty. When chaos spreads through financial markets, the instinct is immediate. Find something solid, something predictable, something that feels immune to whatever is breaking. For centuries, that role has been played by a small group of assets: gold, government bonds, and the currencies of powerful nations. These assets aren't just investments, they are psychological anchors. Gold represents permanence, a metal that survived empires, wars, and currency collapses. Government bonds represent authority, the promise that the most powerful institutions in the world will honor their debts. Reserve currencies represent stability, the financial backbone of global trade. When markets panic, these assets become the financial equivalent of lifeboats. But lifeboats only work if the ship sinks slowly, and history shows that financial crises rarely unfold slowly. Consider one of the most famous financial shocks of the 20th century, the early 1970s. At the time, the global financial system was already under pressure. The United States had recently abandoned the gold standard. Inflation was quietly building inside the world's largest economies. Energy demand was exploding as industrial growth accelerated across the developed world. Then, in October 1973, a geopolitical crisis erupted. The Yom Kippur War broke out in the Middle East. Within days, the conflict triggered a massive strategic response. Arab oil-producing nations imposed an embargo against countries supporting Israel. Oil exports were restricted. Supply collapsed, and suddenly the global economy faced a shock it had never experienced before. Energy prices didn't just rise, they exploded. Oil prices quadrupled in less than a year. For modern economies built entirely on cheap energy, the effect was devastating. Inflation surged, production slowed, markets became unstable, and investors around the world did what investors always do when chaos begins. They ran toward the safe assets. Gold looked unstoppable. The metal had already been gaining attention after the collapse of the Bretton Woods system. Without the fixed link between the dollar and gold, prices were free to move. And during the oil crisis, the narrative seemed perfect. Inflation was rising, currencies were weakening, governments were losing control. Gold, the ancient store of value, appeared to be the obvious solution. Money poured into it. From 1971 to 1974, gold prices surged dramatically. For investors watching the headlines, the conclusion felt obvious. The crisis had arrived, and gold was doing exactly what it was supposed to do. Except the story wasn't that simple, because the oil shock that began in 1973 didn't produce a short financial panic. It triggered a decade-long transformation of the global economy, and that transformation revealed something investors rarely consider. Safe assets are only safe under certain conditions. Change the environment, and their behavior changes too. The oil embargo didn't just raise energy prices, it rewired the economic system. Energy became expensive. Production costs soared. Consumer prices followed. By the late 1970s, inflation across major economies had reached levels not seen in generations. In the United States, inflation climbed into double digits. Central banks faced a terrifying dilemma. If they kept interest rates low, inflation would spiral out of control. If they raised interest rates aggressively, they risked crushing economic growth. Eventually, they chose the second option. Interest rates began rising sharply. And this is where the story of safe assets becomes complicated, because rising interest rates changed the rules of the financial game. Gold is often described as an inflation hedge, but gold has a hidden weakness. It does not produce income. No interest, no dividends, no yield. When interest rates are low, that weakness doesn't matter. But when interest rates rise sharply, investors suddenly have alternatives. Government bonds begin offering high yields. Cash accounts start paying meaningful returns. And suddenly, the opportunity cost of holding gold becomes very real. During the late 1970s and early 1980s, this dynamic created enormous volatility. Gold didn't move in a smooth upward line. It surged, collapsed, surged again. At one point in 1980, gold prices briefly exploded to nearly $850 per ounce, an extraordinary spike fueled by inflation panic and geopolitical fear. But the spike didn't last. As central banks tightened monetary policy and interest rates climbed into the double digits, gold eventually entered a long and painful decline. For the next 2 decades, the metal that had once seemed unstoppable quietly drifted downward. Investors who had bought during the panic discovered something uncomfortable. The asset that felt safest during the crisis turned out to be extremely sensitive to the policies that followed it. Gold wasn't the only safe asset facing surprises. Government bonds, the traditional refuge during market turmoil, were also caught in the same storm. Bonds depend on stability. When inflation rises rapidly, the fixed payments bonds provide lose value in real terms. This means that during periods of high inflation, bonds can quietly destroy purchasing power. And that's exactly what happened during the 1970s. Investors who believed government bonds were the safest place to hide during economic instability discovered that inflation could quietly erode their wealth year after year. The lesson was brutal. The definition of safety depends entirely on the type of crisis unfolding. Inflation punishes bonds. Rising interest rates challenge gold. Currency instability can threaten both. Safe assets are not universal shields. They are tools designed for specific environments. Why do investors repeatedly fall into this trap? Because safety is rarely about mathematics. It is about psychology. During crises, investors aren't calmly analyzing macroeconomic dynamics. They are reacting to fear. Fear compresses decision-making. Instead of asking complex questions like, what type of crisis is this? Investors ask a much simpler one. Where does everyone usually run? And that instinct creates powerful feedback loops. The more people believe an asset is safe, the faster money flows into it during moments of panic. But that same crowd behavior can push prices far beyond reasonable levels. By the time the majority of investors arrive, the protective trade may already be crowded. And crowded trades are fragile. Fast forward to today. Global markets once again live under the shadow of multiple uncertainties. Geopolitical tensions remain elevated. Energy supply routes, particularly around the Strait of Hormuz, are closely watched by analysts and military strategists. Inflation, once thought permanently defeated, has returned in many major economies. Central banks continue navigating the delicate balance between controlling prices and maintaining economic growth. In other words, the ingredients that once defined the 1970s crisis environment are not entirely absent today. And when investors sense that kind of instability, the same instinct returns. Buy gold, buy bonds, buy the assets history labeled safe. But history never promised those assets would behave the same way in every crisis. Financial markets are adaptive systems. Every crisis rewrites the rules slightly. The oil shock of 1973 revealed how geopolitical events could trigger inflationary spirals that reshaped entire economies. The inflation crisis of the late 1970s demonstrated how rising interest rates could transform the behavior of assets investors believed were reliable. And the decades that followed showed that no investment remains permanently safe. Safety is contextual. Gold can protect against currency collapse. Bonds can stabilize portfolios during deflationary recessions. Cash can provide flexibility during market crashes. But none of them are invincible. The true danger appears when investors forget that distinction. When safety becomes a narrative instead of an analysis. The idea of a financial bunker is comforting. The belief that somewhere in the market there exists an asset immune to chaos is deeply appealing. But history suggests something different. Crises don't just break markets. They expose assumptions. They reveal which beliefs investors accepted without questioning. And again, the belief that certain assets are universally safe turns out to be one of the most fragile assumptions of all. Because the moment everyone runs toward the same shelter, The shelter itself becomes part of the storm. This doesn't mean safe assets are useless. Gold, bonds, and reserve currencies still play crucial roles in financial systems. But the investors who navigate crises successfully tend to think differently. Instead of asking, what is the safe asset? They ask a more difficult question. What type of crisis are we actually facing? Inflation crisis, currency crisis, debt crisis, energy shock? Each scenario produces different winners and losers. And the difference between protecting wealth and destroying it often comes down to understanding that distinction before the crowd does. Because in finance, the most dangerous assumption is not that markets will crash. It is believing that the solution will always look the same as it did last time.